If you're running Facebook ads but not getting the conversion you want, well, guess what? Carl White and Chris Johnstone got it all figured out. They know exactly how to do it. They will get you converting like you wouldn't believe. It's an ongoing webinar series. Yes?
Did you see Carl White hanging out with Jack Black?
I did. What's up with that?
Jack Black seems like he'd be fun to hang out with.
Absolutely. Anyway, they've got a banner you see right here. It's over on your right. Might have to scroll down a little bit, and I'll put it down below as well, but don't miss it. Ongoing webinar series, convert more deals and ads and leads.
Jack Black.
Jack freaking Black.
All right, boys and girls, here we go. The amount of Freddie Mac loans that have some form of risk sharing is up to 39% from 30%.
Right.
That's 9% up, okay? Now, what that means is that Freddie's risk exposure went down, and with limited exposure on nearly 40% of their portfolio, it's actually quite a bit down.
Okay, so here's the thing. The GSEs take a guarantee fee, or a G fee, to create a pool of money because they assume the risk. It's their insurance policy against foreclosures.
Right.
So, now some are speculating that the G fee may be reduced. Because Freddie doesn't assume as much risk as they had in the past. Now, that makes perfect sense, and now we're going to tell you why it's not going to happen.
Okay, and for those who don't know, GSE means government-sponsored enterprises, and that would be Fannie Mae and Freddie Mac. Okay, so I just want to get that out of the way here.
Sure.
So here's why it's not going to happen, why your guarantee fee on your Fannie Mae and Freddie Mac loans is not going to go down. First, our government has a history of using the GSE's guarantee fees for things other than foreclosures, reallocating that money for stuff it wasn't intended for. That's what they do. For example, the government reallocated G fee funds from Fannie and Freddie to fund a massive transportation bill, and I think that was in 2010.
Brilliant.
No, so they used that mortgage guaranteed money to fix roads, build bridges, and put up stop signs. Not exactly what it was intended for.
Crazy.
Further, parts of the G fee were actually used to clean up the BP oil spill. Remember that in the Gulf of Mexico? Not exactly what it was intended or earmarked for. So, like Social Security money, when the government starts spending money on unrelated things, it becomes very, very difficult to get them off that tit.
It sure does.
Yep.
Secondly, Fannie and Freddie are still in conservatorship.
Right.
As you recall, the Treasury decided in 2012 to change the terms of that GSE bailout, a move to sweep all funds rather than pay off or even pay on previously agreed upon dividend payments on the Treasury's preferred stock. So again, the Treasury's gotten pretty accustomed to taking these billions of quarterly dollars, and that will not change till the GSEs are taken out of conservatorship and or overhauled.
Can you picture over there at the Treasury, they're just going, what should we do?
I know.
Let's just take all the money.
Just take it all.
Let's just take it all. So, though the GSEs should reduce the G fee, and some are speculating that they will lower the G fee, we're here to tell you that Harvey Weinstein has a better chance of attending my daughter's slumber party than the government lowering the G fee.
Oh, Brian Stevens. In other news, mortgage applications are down in general, but I know people who are still kicking butt out there. Refinances only represent 36% of all volume, and having watched this stuff for a long, long time, that number is low, super low, and no relief is in sight for that guy. So, we're gonna help you out.
All right, how are we gonna help? Oh, I got it. Here, okay, just read the prompter. Stop targeting refis. In a volatile and upward moving market, the rate everyone really wants to get from you is 0.25% lower than whatever the hell rate you're quoting them at the time. Okay? That's everybody. Because refi markets are rate driven.
Yep.
You're currently in a market where you could not win because what you quote today is higher than yesterday and what you quote tomorrow is higher than you quote today.
Right.
Because we've seen such a drastic spike in rates. Homeowners right now have this delusional belief that the 4% rate they got a couple of years ago is a standard market rate. And it is decidedly not a standard market rate.
Right.
It's really somewhere around 7%. So refis are a carnival game. Sure, they look easy, but you ain't ever gonna win that prize now, are ya? No, no, no.
Secondly, of course, for you loan originators out there, go work with real estate agents.
Yep.
Don't sell rate.
Nope.
Sell your service,
Yep.
right? Because buyers also want 25% lower than your quote, just like refis, yet the determining factor is the house and not the rate. So what you need to do is sell your service and your abilities and generate clients. That's right, you generate clients. If you do that, you have a chance to take a piece of the pie. If you don't, your business is going to falter. Just food for thought. Eat that pie.
Side note, work with agents, but not the Keller agents who have that stupid form that they hand out to all your referrals. Just can't let it go, can I? Just can't let it go.
All right, you guys have an
By
awesome
the way,
day.
EXP is great. EXP, if I was working at Keller, I would totally look into EXP right now.
Yeah.
I would. I mean, boy, thinking about more money, they've got great training. EXP is a great alternative for Keller Williams real estate agents. I'm just saying, I think it would be personally.
It's the NREP theme for 2018. It's never going to go away.
No.
You guys have a great one. Leave us your comments down below. Forward, share, and subscribe. We'll catch you later here at the National Real Estate Post.
EXP. Oi. 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 EXP. The dynamite.